Let's move to today's most important stock, Nvidia. Shares of the company are lower despite the fact that it beat top and bottom line expectations, grew revenue by more than 120%, gave solid guidance, and announced a $50 billion stock buyback. Expectations were apparently so high for Nvidia that it appears anything short of crushing even the most optimistic forecasts is being seen as at least a mild disappointment. Joining us now, Chris Caso, Wolfe Research senior analyst. So, Chris, I guess a little bit of noise in terms of the cadence of production for the next generation of processors. You have a little bit of margin compression, perhaps, in the end of this fiscal year. But is there anything in the results or the guidance that makes you rethink the pace of demand or the overall story?
It really doesn't. And, as you said, expectations are high into the report. The magnitude of the beat is a little bit less than what we've seen in some quarters. It's about 2.5% over consensus for the guidance. But, what was clear is that demand is still well ahead of supply. Supply is still coming, and that's what's allowing revenue to grow into the second half of the year. And as you look into next year, the optimism in the stock, at least our optimism, is the new product family, Blackwell, which adds a lot of content. And what I think they did well on the call is acknowledge some of the chatter that's been out there about some of the changes to the architecture of that product. However, it's still coming out in the fourth quarter of this year, and they said several $billion of revenue. And I think that makes people feel good about the next product cycle and the content that comes with that.
I guess that, if you really want to kind of broaden out the story, it's really about how many years of this type of urgent demand and build out are we in for here? I mean, it doesn't feel as if, because it's such a capex heavy sector of tech, because it takes such deep pockets to get these facilities built and to keep reinvesting in this area. It feels as if we're going to get to a point where, not that it's done, but that the urgent part of it is done. So, do we have clearance through fiscal 2026 at this point that we're not going to hit that point?
Yeah, and it's a good question. And really it comes down to, for how long are the hyperscalers, the enterprises continue to put the capex in place for this? And one part of it, and you mentioned it in the prior segment, is about getting an ROI on that. It's early days in AI right now, so not everybody that's spending is getting an ROI, but a lot are. And then, from there, it's a question of, when does this kind of get to maturity? And the way that we're approaching it is, listen, we look at the data points, we keep taking a look, 1 year at a time product cycles, and at least for this product cycle coming up, demand is not being fully fulfilled by supply, and supply is coming on. So that's giving room for numbers to go higher. And then content's going up. And it's one of the things that is now changed in the world of semiconductors, is that pricing goes up every year now because it's more expensive to make these chips, and you need more transistors to drive that performance. And as long as that's happening, the stock is going to continue to work.
All right. And just real quick, what's your target on the stock as it sits at 121?
It's a 150 now, outperforming $100.